Hello traders, good morning, good afternoon, good evening, bonjour, bonsoir mes amis, guten Morgen, guten Tag, guten Abend. For those of you who are new to us, we are the TSTW SYS008 traders. This is a trading tutorial posted by 24 Elliott Waves. The title of the video is Learn Why the Fourth Elliott wave should not overlap the first wave. All right. So recently I have recorded a video and we were talking about the third Elliott wave, and I was explaining to traders why the third Elliott wave should not be the shortest wave. All right. Check it out at 24 Elliott Wave YouTube channel. All right. Very interesting or essential trading tutorial for traders who want to master the wave principle. So by the way, I received an email from a trader about wave count. I will get back to you very shortly. All right, so do not worry. So we are looking at Nike stock. This is American stock listed on the Dow 30 Epic November Kilo Eco NKE. Okay, we are on a monthly chart, and recently I also recorded a video that we call how to combine the wave principle and the Fibonacci time zone. And I've counted 5 Elliott wave. Okay, first wave from here, second wave, the red line. Okay, and then we have a kind of complex second wave here, and then we have the third Elliott wave has been the longest wave, followed by the fourth wave, and the fifth wave has been a complex fifth wave that has been divided in 5 minor waves. And I was telling you that Nike stock will have difficulties to cross the level of $100, okay, provided that the fundamentals are weak and the market sentiment is bearish toward this stock. And for 2 months, I recorded a video in December, is still coming down at the end of the fifth wave. So in this video, we want to talk about why the fourth Elliott wave should not overlap the first wave. The first thing I want to say to traders that are learning to count Elliott wave, if you are making mistakes, it's normal, okay? So it's part of the trading. Do not be discouraged. Keep learning, keep improving. The most important thing, draw channels, okay, draw support and resistance level, and you are likely to count the wave accurately. The most important thing when we are counting the wave is that we want to align our wave count with the market pattern. Is it trending up? Is it trending down? Is it in a horizontal market pattern? Also, to answer one question that a trader asked me recently about the Australian dollar US dollar currency pair for wave count, do not count Elliott wave on one single time frame. Like I'm doing here, I will validate my setup on a higher time frame. After the wave count, I'll look on the quarterly chart, I'll look on the yearly chart to see whether everything aligned carefully. Yes, it did align carefully. But if suppose you're on a 30-minute chart, you are counting Elliott wave, or 4-hour chart, you are counting wave, or hourly chart, daily chart, weekly chart, you want to, after you count the wave on the time frame that you have chosen, you must now go to the higher time frame to see that everything has aligned carefully. Why? Because sometimes you may count the wave, and once you look on the higher time frames, you may see that it doesn't make any sense at all, and you will know straight away that you have made a mistake. All right? So keep improving, keep working on it. Okay? Let's go back to the monthly chart again, and we want to talk about why the fourth Elliott wave should not be the fourth Elliott wave should not overlap the first wave. What do we mean by should not overlap? So this is the first wave here, you see the blue line here, and I highlight the range of the first wave by the 2 lines. So I'm going to color them now into red, so you can see the 2 horizontal red line which are highlighting the range of the first Elliott wave. What we meant by the fourth wave should not overlap the first wave, it means that the fourth wave should not come down all the way to the range, of the first wave. So the fourth wave is the fourth wave here. This is the fourth wave right here. Okay, it shouldn't come all the way inside this section here. You can see that for Nike stock, it came down all the way, but did stop on top of the first wave here. If it went below it, that will be a violation of the wave pattern. sometimes you may see that you may quickly go through it, so you may see a tail, so but that tail should close, the price must close above it. All right, so we don't want it to go inside the range of the first wave. Now the question, why are we recording this video? Because understanding is the key to every success. Okay, you want to enjoy trading, you want to understand trading, you want to enjoy Elliott wave trading, you want to understand the wave principle. Okay, you want to enjoy football, you want to understand the rules that govern football, you want to enjoy rugby, you want to enjoy cricket, you want to enjoy American football, you want to understand tennis, you want to enjoy it. Okay, you want to enjoy the game, you must understand the game. So the purpose of this video is to allow traders to understand the game of Elliott wave trading. So some traders may think that this video is useless. George, I can't use it to train, but this is the foundation. All right, so once you start understanding what's going on, okay, you are likely to make better decisions. That's why I spend time to explain to traders, okay, why I'm taking this trade, why I count the wave, the guideline they should follow. I hate traders to depend on me. I want traders to be independent and to be able to make their own decision. Very, very important for me. All right, so let's start it. Let's get started, okay? Why the fourth wave should not overlap the first wave, all right? In a normal, we are now concentrating on an up move, so because the stock here is going up. What I'm going to say here is also true in a downtrend, but we're going to focus on an up move, okay? So in an uptrend, the price must display higher lows and higher high. A high, okay? There was the low here, all right? So the low of the first wave, followed by the low of the second wave, all right? So the low of the second wave is a higher low compared to the low of the first wave, all right? The primer display higher lows and higher high, okay? Now, this is a normal progression in an uptrend. So if you are using the Elliott wave, you want to count wave, talking about the motive wave formed of the first wave, second wave, third wave, fourth wave, and fifth wave. It's a trending period. So the channel should be going up. So during that time, okay, the second wave and the fourth wave are contra trend. So if you're in an up move, okay, or even a down move, the second wave and the fourth wave during the motive wave are contra trends. So this is a kind of profit taking. What do we expect? Traders who are using the volume bar will know that a normal contra trend, an ordinary contra trend, should be with a low trading volume. So we don't want the majority of market participants to be selling in an uptrend. So when the price is going down, we don't want to see too many market participants taking part in it. So we want to see the retracement in an uptrend to be shallow, all right, under low volume, all right? So suppose we are in a fourth wave, all right, and the price going down, okay? It shouldn't be under, okay, a high volume. But if you look here, this is the year 2008 up to 2009. This is, okay, a bearish season for the market itself. 2008, the financial crisis, okay, the real estate, okay, madness, all right. So it was a bearish season. That's why you can see that it went down all the way, almost went into the range of the first wave. This session here, we understand why the fourth wave went deep like this, because it was, okay, a bearish season. In a normal bullish progression, the fourth wave is very, very shallow. You can see that after the correction, we have an extended, okay, fifth wave, all right? So the reason why the fourth wave will find it very difficult to go into the range of the first wave is that it's a correction, all right? It's not part of the normal trend. So in the uptrend, we have a mini bearish trend. In a downtrend, we have a mini uptrend that rally. These mini rally in a downtrend should be with a low trading volume. And these mini bearish trend during an uptrend should be under low trading volume. So it shouldn't be too big. One thing also we want to understand, okay, if we are in an up move, okay, the length of, talking about the magnitude or the length of the contra trend, talking about the second wave and the first wave, should not be bigger than the impulsive wave. So first wave, third wave, and fifth wave should be longer, should be more solid, okay, than the contra trends, second wave and the fourth wave. So if, for instance, we see the fourth wave going down too far, which means it's end up being longer than the first wave, this is not a normal uptrend. It's not a trend happening here. It's something else. All right. So we will expect the fourth wave to be shorter than the first wave, third wave, and the fifth wave, not too significant, okay, under low trading volume. So according to the Elliott wave principle, if we have an uptrend, okay, a normal uptrend, a healthy uptrend, the fourth wave should not go all the way into the range of the first wave. So we shouldn't have a significant down move in an uptrend. The down move in an uptrend should be insignificant, should be under low trading volume. That's why one of the rules about the Elliott wave is about, okay, the fourth wave should not overlap the first wave. Another reason why the fourth wave should not overlap the first wave is this. You see, whenever you see a price move, okay, so here, you see it went up from here to here, yes or no, okay? All right. So what do we need to pay attention to? We need to pay attention all the time you see that. Okay. Draw the Fibonacci retracement tool and highlight the 50% of Fibonacci retracement level. All right. In normal bullish progression, ladies and gentlemen, all right, if the movement, the progression, the bullish progression is strong, the price will find it very difficult to go below the 50% Fibonacci retracement level, which is, okay, a psychological price level. In fact, that's what we call the third psychological price level. So a bullish progression that is strong, a bullish move that is strong, the price will find it very difficult to go below the 50% of the price. So you see here, it went up like this. Okay, if this bullish momentum is very strong, the price will find it very difficult to go below the 50% level. Again, here you can see this move here from here all the way up here. If this is truly this move here is a correction, the price will find it very difficult to go below the 50% level. Sometimes you will see that you go up to the 61.8% Fibonacci retracement level, but will quickly come back above the 50% level. It shouldn't stay below the 50% level. But based on the Elliott wave rule that stated that the fourth wave should not overlap the first wave, if we have, for instance, the fourth wave going down like this, all the way to the range of the first wave, you see the first wave here, now my fourth wave goes into the range of the first wave, it means that, okay, the price went down below the 50% Fibonacci retracement level of the third Elliott wave, which is completely, okay, abnormal during an up move. It is also completely abnormal during a down move that the fourth wave goes below the 50% of the third Elliott wave. Because why? The third Elliott wave usually is the longest wave. It shouldn't be the shortest wave. Okay, sometimes it's not the longest, but very often it's the longest. All right, so what is happening during the consolidation phase, following our guideline, we know that consolidation. Another question I want to answer for a trader that asked me a question about, okay, on a 30-minute chart about Australian dollar, US dollar currency pair. You want to count wave, look for consolidation first, okay? That will allow you to count useless wave, okay? Consolidation, breakout, pullback, blah, 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 and so on, okay? Look for consolidation and start from there, all right? That's what I'm looking for all the time. This helped me to avoid, okay, crazy wave count, okay? So the first buyers, okay, the first buyers are the ones that are buying during the consolidation phase. They are also the author or the creator of the first wave. In fact, as I put it to traders, the first wave is the signature of the bulls. We want it to be strong. We want it to break resistance on the left-hand side. This is the guidelines that I give to traders, okay? So the whole multi-wave, okay, or the root of the whole multi-wave is within the consolidation and the first wave. Those first bias are the root, form the roots of the multi-wave. So if, for instance, during the third Elliott wave, they came out of the market, it means that we don't have a trend. They are using fundamental analysis to buy at the best price at a low risk entry point. But if we see the third Elliott wave and the fourth Elliott wave goes all the way beyond into the range of the first wave, it means that these first buyers came out of the market. They are no more in the market, and you need to pack up also, and the trend is likely, okay, to stall. It's likely to stall, okay? So another thing also, we need to understand why the fourth Elliott wave should not go into the range of the first wave is that, suppose we draw a channel, so we know that, okay, in a normal trend, so whenever you are counting wave, think of trend, all right? This is one thing you need to understand. Think of trend, all right? Apart from the corrective wave. So the multi-wave, first wave, second wave, third wave, fourth wave, fifth wave, think of a rising channel, think of a declining channel, think of a trend. This will allow you to come to avoid all sorts of trouble. Even if you count, okay, a flat correction 1, 2, 3, 4, 5 as okay, impulsive wave, you made a mistake for the name, but you are on the right side of the market talking about a flat correction. Okay, so this is something else that we have already talked about. Okay, let's see how long I've been talking to you now. 60 minutes. I got 4 minutes more left. I'm under pressure. Okay, so in a normal up move, ladies and gentlemen, so here we will draw a channel like this. So how do we draw a channel? We will draw the low of the first wave and the low of the second wave. That's the first line. And then we will draw another line above the high of the first wave, something like that. You will see that if the bullish momentum is very strong, the price will go above my channel, this blue channel here. This is normal, but we do not want it to go below the channel. So in an up move, the opposite is also true in a downtrend. Because I'm dealing with a Nike stock, we are in an up move. Okay, you understand? So suppose here I have my channel. This is a bullish channel. Whenever you see a rising channel, think of the market sentiment. A rising channel represent or indicate a bullish momentum or a bullish market sentiment. A declining channel indicates a bearish sentiment, okay, or a bearish momentum. This should click straight away into your mind. So suppose the fourth wave goes below, okay, it will go into the range of the first wave, which means it will violate, it will go below this channel. Likely, very often, if it goes into the range of the first wave, unless the first wave is extended, but really, truly, if the fourth wave goes into the range of the first wave, we are likely to see the violation of the market pattern. So an uptrend has violated the rising channel. What is happening? Okay, it means that the bullish momentum is stalling. Traders will try to sell it more, waiting for it to retest the lower part of the channel, and the bearish traders will come back and try to sell it because this trend is no more sustainable or the market sentiment is changing. The bull has a lot of work to do if they want to bring the price back above the channel. The price should not go below this channel in a normal uptrend. This is one of the reasons. So an uptrend that we see now, the fourth wave go crossing below the channel, is becoming bearish. We are talking here about the market sentiment. So I talk about the 50% of the third Elliott wave. Normally, we don't want to go below that level because it's a psychological price level. If the price goes below the 50% Fibonacci retracement level of the prior move, either in an uptrend or downtrend, it's not aligning with the current trend. So 50% Fibonacci retracement of the third Elliott wave. We don't want the fourth wave to go below it. All right? All right. So even here, you can see that though you can see here, let's draw Fibonacci retracement here, okay, of my third Elliott wave here. Okay. That's it. You can see that my 50% is equal to the high of the first wave. It's the thick line here. And the price did stop on it. Why the market was so careful not to go below it? Because if they go below that level, it will trigger a bearish sentiment. The are watching. This is about the language of the price. So attention to the 50% level. The rule of the Fibonacci, the Elliott wave that stated that the fourth Elliott wave should not overlap the first wave is based on the market sentiment, okay, and also about the trend. Okay, so we are watching the 50% level, and we are also watching the channel, which represent the market sentiment or the bullish momentum if we are in an uptrend. Okay, a declining channel represents a bearish sentiment or a bearish momentum. Another thing why the fourth Elliott wave should not overlap the first wave. I go over my 20 minutes now. Okay, let it run. All right. Okay, sorry, traders. Is that the first buyers, okay, in an up move, the first buyers are, okay, smart money, okay, they buy during the consolidation first at the best place. They know that these financial instruments go up or down, and they are the first people, okay, generating the first wave. So in a downtrend, the first wave and the consolidation is the root of the bearish motive wave. All right, I will be going into that subject, the root of the trend, when I will record another video which we will talk about why there is usually equality between the first wave and the fifth wave. All right, so wait for it, stay tuned, subscribe to it, share this video, give us the thumbs up. Okay, put your comment below if you dislike it, put why you dislike it, or you have something to say, see below, write it below. Okay, I read all the comments, okay, all the time. All right, so very important. So the first buyers, okay, will buy during the consolidation and the first wave. Okay, so if we see after the third Elliott wave that the fourth wave goes back into the range of the first wave, it means that okay, this if we compare the trend to a tree. All right, if you cut the root of a tree, you can do whatever in the world. The tree slowly, gradually will waver, okay, will come back down. The tree will fail, okay? So the root is the consolidation and the first wave, okay? That's the root. These are the first buyers, okay? If they pull out of the market, the fourth wave will go back into the range of the first wave, and we will not have a normal trend. All right, it makes sense? Another reason why the fourth Elliott wave should not go into the range of the first wave, look at this. Okay, I'm going to remove some line on my chart, okay? I promise that I will stay below 20 minutes, okay? All right, you are my friend, you can forgive me, I went above it. All right, it happened because I haven't finished yet, okay? So, all right, so, all right, another reason why, okay, the fourth wave should not overlap the first wave. I want you to pay attention carefully to what I'm going to say here, okay? So we have the first wave and the second wave, all right? For the trend to continue, the first challenge for the multi-wave is what? Look on your left-hand side. The price must find a support above the high of the first wave. This is just critical for the trend to continue, all right? If it fails to find a support above the high of the first wave during the third Elliott wave, we will not going to have an uptrend. The same thing is true in a downtrend. We want the price to find a resistance, okay, during the third Elliott wave on or near the high of the first wave. This is just critical for us. We want to see that, okay? So at this point in time, because the price, we have the third Elliott wave, the price found a support, okay? There was no resistance here. The price just break through it, okay? Just ran fast. It means that, okay, this is a valid support level. There were buyers here. If, for instance, the fourth Elliott wave finally go back below this critical level, which is the high of the first wave, it invalidates this valid support level. So in an up move, we shouldn't have an invalid support level. This is a market stable data. All right, you know that, okay? In a downtrend, we shouldn't have an invalid resistance level. It's just critical. So if the price goes back below a support, so we are in an uptrend, we have a support. Now that support is now converted to a resistance, or that support has failed in an uptrend. A support shouldn't fail in a normal uptrend, not an ordinary support, the high of the previous move after a pullback. This is the first invitation to buy, and people responded. Now the mass, okay, the general, okay, public joined the trend after the smart money bought it during the consolidation of the first wave. Now that support level has failed, which means the price now finally, during the fourth leg away, crashed through that support level. Is contrary to the trend. We should not have an invalid, okay, support level during a normal uptrend, okay? All right. So the first thing first, you want to understand in an up move, we want to see low volume during contra trend, and the contra trend should be insignificant. So fourth wave, second wave should be insignificant under low volume. Now this is an exception here, but the rule stands because it didn't go beyond the range of the first wave. So if we have a high volume during the correction, now we must now check the support level. Now it failed to go below this critical level, which is the high of the first wave. So it all work together, not individually, all together, the 50% Fibonacci retracement level, all right? The violation of a market pattern, rising channel in an uptrend, declining channel, the price should break below the channel. If you violate the channel, the market sentiment has changed, okay? The bullish momentum has changed. Also, the 50% Fibonacci retracement level is the third psychological price level. If it goes below it, the market will react to it. They will react to it. They are not fooled. They know. They will react to it. Okay? And also, we don't want to have an invalid support in an up move and an invalid resistance level in a downtrend, which means if the price goes below the high of the first wave, well, what's happening? We can continue with this discussion going deeper and deeper. I mean, what do I care about? I care about trading, understanding it. And I don't worry about it. You can take a trader a year or 2 or 3 or 4 years to understand the same process I go through. This is what we call the learning curve. But what we have seen recently, a lot of traders are coming to the market and they want to do everything quickly. Okay, slow down a bit, and you will see that. Okay, you can use a demo account. Don't use real money where you are learning. Okay. All right, go gently with the market. The market is always here. And the reason why traders come back to us is because we tell them, okay, what is true? And traders go through different stages. And they know that, okay, one thing I do not do, I don't lie to traders. I don't fool traders. And they will respect you for that, okay? Very, very important. Losing trade will happen. Emotion get into the trade, but we don't want emotion in the trading market, all right? But slowly but gradually, okay, every trader will mature and will improve, okay, his or her decisions. It makes sense? So mini contra trend in an uptrend. So we have an uptrend. We will have mini contra trend, which are bearish trend. We want them to be without force, okay, under low trading volume, all right? The magnitude of the contra trend should not be longer or bigger than the impulsive wave, okay? Okay, we shouldn't have an invalid support during an up move, an invalid resistance during a downtrend, okay? The root of the trend is the first buyers during an up move or the first sellers during a downtrend. This is represented by the first wave, okay, and the consolidation first. You will see that the trend, what you see now, during the normal, so we have normally the area wave cycle is formed of the first wave, second wave, third wave, fourth wave, and a fifth wave. Yes or no? All right. Then we have a correction that is ABC. During that correction, you will see that the price will go below this low here. The price during the ABC correction, finally, when the correction itself is started, which means the first buyers will close the trend. So when we are talking about the equality between the first wave and the fifth wave, I'll be talking about that. Those who started the trend form the root of the trend, and they will be the first to close the trend. If they don't come out, the trend will remain in place. All right? So you see extension, or a shallow correction and another trend. If the first buyers, which we call the call buyers or the call sellers, okay, do not come out of the market, all right? So you have to understand what is happening so you don't trade the price alone. You pay attention to the market participant and the price itself, combining the technical analysis and the fundamental. So during a normal correction that we have ABC, you will see that we will see a violation of the trend. Why? What is the violation of the trend here? The price will go below the high of the third Elliott wave and also below this higher low here, ABC, and you will see that, okay? Or else you will see that, okay? It makes sense? And now we see a violation. So in an up move, we shouldn't see a violation. So that's why the fourth Elliott wave should not go into the range of the first wave. This is the range of the first buyer, the root of the trend. If the bear managed to push it back in that range, it means that the bulls are under pressure or the first buyer are under pressure. The same thing is true in a downtrend. Okay, the price should not overlap the fourth wave in the downtrend, should not overlap the first bearish move. I hope you have learned something from this video also, and we put into use to improve your Elliott wave trading. We are the TSTW SYS008 traders. This tutorial is posted by 24 Elliott Wave. Subscribe to 24 Elliott Wave YouTube channel. Happy trading to you all, and speak to you soon.